Welcome back as we discuss indices for alternative investments. Alternative assets are of interest to investors because of their potential diversification benefits. Alternative investments include hedge funds, private equity funds, real estate, commodities, infrastructure, and other rare items like fine wine and antiques. They're taught in detail in the course on alternative investments, so we shall just briefly introduce them here and place our focus on the unique features of their indices. We shall discuss the indices of the more widely held alternative assets, commodities, real estate, and hedge funds. Commodity indices represent futures contracts on commodities such as agriculture, metals, and energy. The key term to note here is futures contracts, in which the returns are not solely from the change in spot price. Commodity futures returns include roll yield, which is the yield capture when the futures price converges to the spot price, and the collateral yield. For details, refer to the commodities section in the Alternative Investments course. Furthermore, the contracts mature and must be replaced over time by other contracts. For these reasons, the return on commodity futures can be quite different from the return based on changes in the spot prices of the commodities. Another distinction to note is the weighting method used. Some commodity index providers use equal weighting. The Commodity Research Bureau Index uses such a weighting scheme where a fixed number of commodities are weighted equally. Some other indices weight based on global production values. The S&P GSCI, for example, uses a combination of liquidity measures and global production values in its weighting scheme. And others use fixed weights that the index provider determines. As a result of the different weighting methods used, different indices have significantly different commodity exposures and risk and return characteristics. Real estate investments can be in the form of direct investments in physical, commercial, and residential properties, or indirect investments through securities such as real estate investment trusts or REITs. REITs invest in properties or mortgages and then issue ownership interests in the pool of assets to investors. REIT shares trade like any common shares in the stock market, and many offer very good liquidity to investors. For physical properties, real estate indices can be constructed using the returns based on appraisals of properties or repeat property sales. For REITs, there are numerous REIT indices that represent publicly traded REIT shares. Because REITs are continuously traded in the market, REITs indices are updated much more frequently than appraisal and repeat sales indices. FTSE International produces a family of REIT indices that seeks to represent trends in real estate worldwide. And lastly, we have hedge funds indices. Hedge fund indices reflect the returns on hedge funds, which are private investment vehicles that manage portfolios of securities and derivative positions, using strategies like leverage and long and short positions. Most hedge fund indices equally weight in the returns of the hedge funds included in the index. Hedge funds are largely unregulated and are not required to report their performance to index providers. Consequently, some funds will report to one index but not another. The performance of different indices can thus vary substantially. Furthermore, it's often the case that those funds that report are the funds that have good performance. Poorly performing funds do not want to publicize their performance. The result is an upward bias in index returns, with hedge funds appearing to be better investments than they actually are. And that concludes this lesson on alternative investments indices. Up next, a comparison chart of some of the more notable market indices from around the world.